Hello everyone and welcome to our June quarterly market update for 2021. Leaping straight into it, this slide shows the growth of $1 invested in various asset classes over the 3 months to 30 June 2021. The top performer for this quarter was unhedged international shares, excluding Australian shares, which would have grown to around about $1.08. Now this is based on the accelerating rollout of the COVID-19 vaccine. As at the end of June, approximately 23% of the world had received at least one jab. In second place was those same excluded Australian shares, which would have grown to around about $1.07 as at the end of the quarter. Now this is really on the back of commodities having a really strong run, and of course the Australian market having lots of resource stocks. The worst performer for the quarter would have been New Zealand cash, which unsurprisingly would have turned $1 into just barely more than $1, $1.002 to be exact. In the middle of the pack is a 50-50 mix of shares and property and cash and fixed interest, which would have grown to around about $1.03. That's a really good, solid quarter. What about the year? Over the full year, we have seen some genuine diversification. For 1 year, every growth asset class has produced a positive result. On the contrary, fixed interest asset classes delivered negative returns. In isolation, that doesn't sound very good. However, it's really important that we have things that zig when other things zag. That's how diversification works. Now, as it happens, the things that zigged really zigged, so the things that zagged didn't matter too much. Top of the pops is emerging markets, where $1 invested 12 months ago would have grown to around about $1.31. Second equal were unhedged international shares and Australian shares, which would have grown to $1.28. Both emerging markets and Australian shares really benefited from that extended commodities run that I talked about earlier. $1 invested in New Zealand corporate bonds would have turned into about 99 cents, as interest rates in New Zealand have actually increased over that 12-month time period. $1 invested in that 50-50 mix of shares and property and cash and fixed interest would have grown to just over $1.16. That's a pretty good year. How about over 3 years? This slide shows the growth of $1 for those same asset classes over 3 years. The top performer, again, is unhedged international shares, which would have grown from around about $1 to round about $1.48. That's first, second, and then first again over a quarter, 1 year, and 3 years. World equity markets have done very well. $1 invested in New Zealand property would have grown to approximately $1.45 at the end of 3 years. Low interest rates have been really positive for asset prices in New Zealand. Middle of the pack on this chart is that 50-50 mix of shares and property and cash and fixed interest. $1 invested 3 years ago would have grown to around about $1.24. That's around the long run average of that mix of portfolio assets. And that includes a time period of the COVID crash. That's interesting. Like most offices around the country, we stopped to watch the penalty shootout that decided the final of Euro 2020 played in 2021. Apart from feeling bad for the penalty shot takers who missed, it is absolutely the worst place to be on a football field. It got me thinking about home country bias. I was reminded that focusing too much on any one thing can lead to calamity. There are good reasons to have a home country bias in investment portfolios. In New Zealand, we have imputation credits which we can offset against New Zealand tax. We're trying to protect against New Zealand inflation because that's what our clients face. So something of an overexposure to New Zealand equities makes a lot of sense. We also happen to have had one of the best performing markets over the last 10 years, although not in the last 12 months or 3 years. To put home country bias in context, the total value of the New Zealand share market as a proportion of the overall market capitalisation of the world is less than 0.2%. Too much home country bias to New Zealand would lead to a very large overexposure to New Zealand on a market capitalisation weighted basis. Sometimes that will work out well, other times not so much. As a reminder, the best performing asset class over the last quarter and 3 years was unhedged international shares, not New Zealand shares. Home country bias makes sense, but when a market faces idiosyncratic risks, such as biosecurity incursions, or as a small and shallow market like New Zealand's is, it makes sense to temper that bias. I hope you found this update interesting, and I look forward to updating you again following the next quarter.